Something we covered before, we've talked about that a number of times, is the PE ratio. The PE ratio basically is the price of a share divided by the earnings per share. And again, generally, there's a rule of thumb here. Lower is better. Why? If the price of the share is quite low compared to the earnings you get from it, that means you're probably getting a share that is reasonably good value. If the price of a share is much, much higher than the earnings you get from a share, there's often a much greater risk involved in that particular share. There's much greater uncertainty about the valuation of that particular share. Now, just looking at some examples, in our environment, if you look at a share that has a very high P ratio, it could be something like Curo. Curo is the company that does private schooling. Right now, the P ratio is quite high. Why is that? It's because Curo is in a high growth phase. If you have a very high growth rate, you can justify a high P ratio. Why? Because you say, yes, earnings right now are not that great, but earnings in the future will be much higher. And so we can't just pay for the earnings right now. You have to pay for the entire earnings, current and future earnings of a share when you buy a share. And the future earnings will be very high, and the price should be very high. But you have to have this good growth rate to justify basically a higher P ratio. One of the largest companies in this country is Naspers, which is a P ratio of close to 60. The reason for that is because it holds a huge stake in a company called Tencent in China that has a very high P ratio. A good rule of thumb for P ratios is basically low teens, 10 to 15. Above 15, you're probably getting into the high value. Below 10, you've got to be worried exactly why does this company have such a high P ratio. Maybe earnings right now are very high, but maybe there's something in the stock price or something in the stock that makes you believe earnings in the future will be much lower. If, for instance, you see a company out there with a 2 or 3 P ratio, it means right now earnings are very good, but you expect them to fall dramatically in the future. Otherwise, the market will be flocking to this company because it gives such a huge return on your investment. Generally, I would advise people, unless you have a really good reasoning, to stay away from extremely high P ratio companies, the 60s, the 70s, the 200 P ratio companies. Historically, you'll find, if you use as a rule, investing in lower P companies as opposed to high P companies, those that invest in lower P companies tend to have an overall better performance for their portfolios than those that invest in high P companies. Often people significantly overvalue growth. They don't understand the difficulties involved in achieving the growth rates, and sometimes they don't understand just how long the growth rate needs to occur at certain levels in order to justify very high price levels. But the general takeaway should be you want to be basically in the 10 to 15 level. Above 15, got to be a high growth company. Below 10, look at it for a bit. If it's below 10, there's probably something there that you don't know about. If you investigate and can't find anything else, a company with a P ratio of below 10 is probably a very good company to be in. The next thing we're looking at is market capitalization. Market capitalization is basically the size of a company. Now, the one thing I want to point out is that the share price is not correlated with the high market capitalization. For some of you out there, this is going to come as a no-brainer. Of course, the share price doesn't mean that the market capitalization is low or high. But for some novices, this is often a confusion. For instance, you'll talk about a particular company that has a share price of 30 rands versus a company that has a share price of 100 rands. But the share price of 30 rands does not reflect the size of the company. Just like the share price of 100 rands does not reflect the size of the company. Quite often you can find a 30 rand company being significantly larger than a company with a share price of 100 rands. Why is that? Because the number of shares is not equal. If you have 1 billion shares and use 30 rands per share, the company is worth 30 billion. If you have 100 shares and the company's share value is 100, there's only 100,000 rand market capitalization. Now, in our market, the variation is quite large between the very low market cap companies and the very high market cap companies, from a few million to hundreds of billions. Some companies with valuations in hundreds of billions include Naspers, Bulletin, British American Tobacco, SA Breweries, those kind of companies, Sasol. These are very, very large companies. I would advise novice investors to look at much, much larger companies when they start investing. Why is that? For a number of reasons. Firstly, large companies tend to come with larger trade volumes, therefore high liquidity. Larger companies tend to come with more eyes on them. Therefore, if there is something that's fishy in the company, those large number of eyes would probably find that out. By eyes, I mean other analysts, other investors. Sometimes look at small cap companies and people think small cap companies are the way to go because that's the only way you're going to find your millions in the stock market. Be aware, Looking at small cap companies, there's always a possibility of very small cap companies, something worth 100 million, could one day be worth 100 billion, and then you have 1,000 times return on your investment. But it's often much riskier to get into a small cap company versus a large cap company. And often there's not as much information for retail investors about small cap companies as opposed to large cap companies. The reason being is that the big hedge funds, etc., they can't really invest in the smaller cap companies. They don't really want to put their brain power or focus their minds on looking at them. They can only make significant or important investments given the size of the companies to large companies, excess of multiple billions. Therefore, a company that's worth maybe 100 million will not get many high-end analysts looking at it, and therefore you might, when you look at these companies, be unaware of particular things that are important about them and unable to get a really good feel about the valuation of these companies. Okay, and that's basically been my rundown on the share trading page or the share page on your newspaper. Let's just go to some questions.